Hello and welcome to the Prescribing Prosperity podcast with your hosts, John and Alex Soutsos. Guys, good to be with you again. I haven't seen you in a while. How you been?
Very good, Bill. How are you doing?
Well, thanks. Well, I'm especially excited today because we're going to talk about taxes. Now, before everybody turns off the podcast immediately, we're actually talking about taxes with the funnest tax guide that I know, and a courtesy of you two guys, John and Alex. We have Kim Moody on the podcast today, and people who've been listening to the podcast, that name is very familiar with them. He is a CPA and the founder and director of Canada's premier tax law and accounting firm, and he markets himself under the brand Moodys Private Client. He's a great guy. I enjoyed listening to him last time. He has great coffee mugs, and he is an entertaining guest by any measure. So, with that, let me turn it over to you, John and Alex, and let's get this party going.
All right. Well, thank you very much, Bill. And thank you very much, Kim, for agreeing to be our first return guest to the podcast. You are one of our favorites, actually, probably right up there. I told one of my best friends that you're coming on. He's an avid listener of the show. And when I told him that you were coming back, he couldn't wait for the recording to come out. He said that you were his absolute favorite. He said, Kim doesn't, I'm not going to use the language that he used, but he doesn't mess around, is more or less what he said. And so he appreciated that.
I like it. Well, it's good to be here, guys. So,
all right. Well, Kim, one of the topics that I've been wanting to dig in with you is talking about professional sports. We kind of briefly just touched the surface of it when we spoke last time, and given the way things have unfolded in the last 6 months or so in professional sports, it's become an even bigger topic of conversation, particularly in the NHL. So we're going to get into it, but let's talk about, just on the surface, how does taxation work? So we know for the most part that taxation is based upon residency, although some places, like in the United States, it's based on citizenship. But we often hear in sports about how players owe taxes in each state or province in which they play. Is this statement accurate? And if so, or is it a bit of an exaggeration? How would you tackle this, Kim?
first of all, thanks again for having me here. Appreciate it. I appreciate the kudos. And yeah, I love talking tax. I could talk all day. And so, in terms of sports, that's something that I do a lot of work in. Uh, yeah, and certainly, lots of experience in the Canada-U.S. realm. And you're right. The United States taxes on a citizenship basis for its citizens, and if you're a green card holder in the States, you're taxed like a citizen. But the United States also taxes on a residency basis. So if you're there for too much time, you're going to be taxed on your worldwide income as well. Canada, as you know, doesn't have that system in terms of citizenship and green card. The green card in the United States is effectively just permanent residency. Whereas in Canada, if you're a permanent resident for immigration purposes, that doesn't automatically deem you to be taxed on your worldwide income, because it's based upon whether you're factually resident or whether you're deemed resident. And factually resident is usually, it's a lot more complicated than a lot of people take for granted. I mean, certainly Alex and John and myself, it's pretty obvious we're Canadian residents for tax purposes. We live in Canada. We take advantage of everything that Canada has to offer, and that will make us factually resident. But what if I decided to go live around the world, or live on a boat? One of the most common things I hear is, "Hey, what if I just decided to sail the world? Can I avoid being a Canadian resident?" Nope, you can't, and there's case law on that, actually. And it's actually part of international law that you need to be a resident for tax purposes somewhere. So even though you might be in so-called international waters for the entirety of the year, doesn't matter. You still need to be a tax resident somewhere. And so the short story is, if you're in Canada physically for 183 days or more, or what's affectionately known as 182 days, try that again, more than 182 days, which is 183 or more, then you're deemed a resident of Canada for the entire year, not just that portion of the year, but the entire year. And so that's kind of a warm up in terms of what professional athletes need to deal with. And to address your question on do they need to pay tax on in every state or province, the short answer is yes, because professional athletes are employees. They're not self-employed, even though some have taken the position they are, and the courts have looked unkindly to that over the years. And so it's quite clear that they're employees. And most provinces and states have rules that if you exercise your employment in that state or in that province, that you're going to be subject to tax in that province. If you're, like, for example, a non-resident of Canada, and you exercise employment in Alberta by attending, a Calgary Flames game, which is my team. Not doing so hot this year, although they started off hot. But
they started off great.
I know, but I don't know. They play again tonight when we're, on this recording date here. But we'll see. I'm not holding out a lot of hope for them. But the short story is, if you're an athlete that exercises your employment by playing in a game, say for example in Alberta, Alberta will tax you on that, and so will Canada for that matter, federally. And there's just in reverse, if you play in Nashville, for example, well, Tennessee will charge. And then it gets a little even more complicated because not in Canada, but in the States, there's a number of municipalities which will charge an income tax as well. Like New York City, for example, has an income tax, and therefore you have to, withhold, the team has to withhold and remit to New York City. Nashville used to have, for example, a so-called, affectionately called a jock tax. Every time you would play in Nashville, it was a flat tax that you would pay. And off the top of my head, I think it was $2,500 US or something like that. But they've since eliminated that. And, the so-called jock taxes are pretty rare these days, but it gets complicated in terms of, going back and forth across the border and making sure that your tax obligations and filings are done appropriately.
Right. So would somebody who, I'll take the Leafs, for example, somebody playing for the Leafs, two of their divisional opponents are, never heard of them?
Michael Bublé has a song about the Leafs, just in case you didn't know. Okay.
Does he?
Yeah. Maple Leaf Forever.
Yeah, well, I used to like Michael Bublé until now. I didn't know that.
It's okay. He's a Canucks fan, though. That's the only downside. But we won't hold that against him. So, all right. So you're playing for the Leafs, and you have two divisional opponents who are based out of Florida. So they have, the Tampa Bay Lightning and the Florida Panthers in their division. So does that mean that those players will benefit because whatever it is, 2 out of 7 of their home games every single year, or their away games every single year, are going to be taxed in the state of Florida, so they'll pay a little bit less? Am I following that correctly?
Yes and no. The yes would be a rare yes.
Okay.
It would depend on where you're resident to begin with, right? Remember the boat analysis that I said?
Yes, correct.
You have to be resident of somewhere. So the starting point is, where is that athlete resident? If they're resident in Canada, let's say in Ontario, because they're playing for the crappy Leafs. By the way, did they win last night?
They spanked Seattle. It was an absolute beatdown.
Seattle. Yeah, because I listened to it in my car, but I didn't finish it. So many of
that screams like a closet Leaf fan listening to it on your radio by yourself.
But let's say John Tavares is resident of Canada for tax purposes. I don't know if he is or not, but let's just say he is. Then if he plays in the States, let's say Tampa or Florida, which is a no state income tax state, try that again, no income tax state, that's fine. There'd be no withholdings in Florida. But because he's resident of Canada, more than likely resident of Ontario, he still has that obnoxious overall tax that he has to pay on that, which is over 53% overall. So the short answer is there's really no benefit.
Basically defaults to your place of residency when you're not taxed in another jurisdiction. Okay.
Correct. Yeah, correct.
All right. So often we see players, primarily American players, return home during the off season, and I assume this is as a result of that 182-day rule that you were talking about. I'm thinking,
Yeah.
specifically for the Raptors, although it does apply to some members of the Maple Leafs who would be American residents. Aside from, that's obviously a strategic decision. Am I correct that they would have to return home in the off season? If they were to stay here for the 183 days, would they then owe tax to both Canada and the United States? Because the United States taxes them based on their residency, and then Canada, or their citizenship, and Canada would tax them on the residency. Am I getting that correct?
Not completely, no. So let me just, so remember that boat analogy, right? You
Yeah.
got to be resident somewhere.
Yeah.
Well, take that one step further. You can also be resident in more than one country. So let's say that player who's American and otherwise a non-resident of Canada, let's say they decide to spend 183 days in Canada. Well, ding, 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 all of a sudden, you're deemed resident of Canada for tax purposes, but you're also resident in the United States. And so that's classic, and there's lots of examples of that. But that's the reason why tax treaties exist. So is to avoid double taxation when you're resident in more than one country. And so in this case, what would happen is if that fellow, who's firstly American and firstly subject to tax in the United States, because let's say he's a citizen, spends too much time in Canada, well, now all of a sudden Canada has the right to tax as well. And in order to avoid double tax, because both of them will tax on their worldwide income, what you have to do is go through the treaty. And specifically for I don't know if you have any tax geeks that listen to your podcast, but it's Article 4, Paragraph 2 of the Canada-US Tax Treaty. We call that the tiebreaker rules. You got to go through the rules, which is fairly straightforward in the whole scheme of things, and go through and order these rules, which is generally 4 sets of rules. And then once the rules break you to a particular country, then that makes the other country non-resident. In most cases, what will happen, using the example that you illustrated, if you have an American who has complete roots in the States, his family's in the States, his employment is exercised through an American team, for example, but he spends too much time, more than likely when you go through the tiebreaker rules, he'll break back to the United States and deem Canada to be non-resident. But what that means, though, is that any income that is sourced to Canada, Canada will have the right to tax. So, during the season when he exercises, plays a game in Canada, well, that's sourced to Canada. So Canada will have the first right to tax that. So it gets pretty complicated, but the short story is no, you won't pay double tax in most cases. But the treaty is not perfect. Here's an example that we see in Canada, forgetting the athletes for a second. So, John, let's say that you're a U.S. citizen, but you're also a resident of Canada, and you win the lottery, and you happen to hit it big, $50 million. Do you pay tax on that lottery earnings in Canada?
Well, lottery earnings aren't taxable, are they?
No, they're not. Not in Canada.
Exactly.
But what about the States? Are lottery earnings taxable?
Yes, they are.
Yes.
Yes, they are, says the producer. Yes, they are.
Yes. So what would happen in that case? Well, as a citizen, you're going to have to pay U.S. tax. But in Canada, it's not. Do you get a credit? No. No, the treaty can't help you there, right? And because basically, the way the treaty works is the income there has to be a source of income on both sides of the border. And in this case, Canada doesn't tax it, so there's no source of income. Whereas in the United States, there is. And so anyhow, long story short is that's where the treaty, for example, can get very, very tricky. And by the way, just to illustrate, I picked that lottery winnings because it's easy to understand. But I also had a live case on this. Years and years and years ago, we had a U.S. citizen that won the lottery and called us up for some advice.
Uh-oh.
And we said, are you married? Yep. Is your wife a U.S. citizen? Nope. Are you sure you bought that lottery ticket? Or was it your wife?
I think she was
So
getting groceries and happened to pick that up as a little Christmas gift for him.
you get to issues like that, right? That are more entertaining but very important
Very,
to consider. So
very interesting. So, one of the things that we heard a lot about in the offseason, given that Florida won and not the Leafs, unfortunately. Sorry, Cam. Was the fact that the non-state tax jurisdictions in the last, I'm going to go off the top of my head. I'm pretty sure it's 5 of the last 6 Stanley Cups have been won by non-tax jurisdiction or non-state tax jurisdictions. So Florida, Tampa won it twice, and Vegas won it once.
Is this correlation or causation, Alexander?
Oh, we can debate it because
if it's causation, then we know what the provincial government needs to do in Ontario, don't we?
Yes. Let's start off with just discussing, let's do an example, I guess is the best way to phrase this.
Yeah.
So how much of an advantage is this? So let's take 4 different cities. We have 2 Canadian cities. Let's do Toronto and Calgary. Toronto, obviously, there's provincial tax. Calgary, there isn't. And then let's do 2 American cities. Let's do New York, because obviously they have a state tax, and Tampa Bay, where in Florida they do not have a state tax. So how would $1 million be treated in each of these 4 cities?
Again, it's not as simple just to say that $1 million earned by a professional athlete is going to be taxed. Let's say you got Steven Stamkos, for example, who was still a Florida, playing for the Tampa Bay Lightning, which of course we know he plays for Nashville now, but let's say he was still there. The first question is, where is he resident? That's the first question, right? Well, no doubt that he's going to be taxed as an American resident. But then it becomes, where is he actually going to be taxed on a state level? Well, in his case, well known that he lived in Tampa Bay. He got a big shack on the water. More than likely, and I don't know for sure because I've never acted, and even if I did, I obviously would be prohibited from saying, but I would guess that he would be taxed in Florida. Now, in that case, the bulk of his income, at least half, right? Because half of his games are played in Tampa, would be taxed at the federal U.S. rate, which the highest rate is, call it 37%. It's not. It's a little bit more than that, but it's 37% with no state income tax. Now, take that exact same example and say that he played for your Leafs. Well, at least half of his income is going to be taxed at that obnoxious rate at 53%, right? And because that's the highest provincial rate. Now it's even more complicated than that, because go back to my first example. Steven Stamkos is a resident of Florida. Half his games are in Florida. He won't hit that 37% rate until, I can never remember the top end. Call it $500,000 US, which in his case, he'll hit it pretty quickly. Whereas in Toronto, he'll hit that top rate at, call it $220,000 of income Canadian.
Yeah, like 2 games into the year.
When you translate US dollars, when you translate US dollars to Canadian dollar, that's a pretty quick threshold.
But we get to mingle with polite people, Kim. That's the advantage of being Canadian. Don't you get it?
Sure. Yes, I get it completely. But then, so go back to my original Steven Stamkos example, right? He's resident of Florida. He's playing half his games in Florida. Does that mean that the other jurisdictions that he's playing in will, like some in Canada, some in other states like New York, that they're going to exercise charge tax on his employment that's exercised in that state? Of course they will. So what does that do? Well, that increases the overall marginal rate from 37% to something higher than that, right? So that's why when you see some of these crappy analysis in the newspapers, sometimes they don't get it, right? Because it's a lot more complicated than just comparing tax rates by province and state, because you have to think about where are they playing this year on each thing on their schedule, because that will increase the overall rate. Now, to your point, though, is there a reason why Stamkos, for example, when he signed, what the hell was it, 2018 or whatever his previous contract was?
17, I believe.
17, yeah. Is there a reason why he took a so-called hometown discount in Florida? Absolutely there was, because certainly his financial advisors would have run the mathematics to see, all right, there's this big offer from Toronto. Does that compare adequately, and does it move the needle enough on a tax basis to make it worthwhile? And even if it did, even if the number was 11 million in the States to account for, the foreign currency delta and also the tax delta, is it enough? And I can tell you in general, the answer is no. You can offer a lot less salaries as long as they're resident in that state. Like Matthew Tkachuk, when he got traded to Florida, there's a reason why he signed his contract pretty quickly. Is because the after-tax dollars that he would have earned in Canada versus the States and making Florida his resident was material, very material.
And he can ride around in a golf cart to the practice facility.
Exactly. Yeah.
Which is environmentally sound.
Don't get me going on that stuff.
Oh, we will later. Don't worry. I can't wait to wind you up on that. But
if we all lived on golf communities, the planet would be so much better off.
Oh, for sure. For sure.
Just think of all the grass absorbing all that carbon emission.
Except they don't like it because they use a lot of water to water the fairways and the greens. So
that's okay. There's lots of hurricanes in Florida.
All right. So basically, we've come to the conclusion that the Canadian teams in the high tax jurisdictions, read Toronto, are effed when it comes to trying to negotiate against no state tax.
Well, they're certainly at a significant disadvantage, right?
Yes, you have to overpay in order to accommodate.
Yeah, or there has to be some sort of enticement there, right?
Yeah.
There's actually a better than average article written in The Athletic. I don't know if you subscribe to The Athletic, but they wrote a piece on that. Oh God, when was it? About 6 months or so ago. It was not bad. There was a whole bunch of tax errors in it. But the conclusion of the article was, what I agree with, is that Canadian teams certainly are at a disadvantage. And you started off by saying 5 of the last 6 teams that has won the cup are in low state. I think their conclusion and their premise, at least anyhow, was that having low tax helps attract free agents.
Yeah,
I agree with that. Whether or not that contributes to helping them win a Stanley Cup or not, I think that's a bit of a leap of logic in my view, because there's a whole bunch of factors that go in.
Yeah, or even if it just comes to retaining your own talent, you obviously need to build a good foundation, a good roster in order to have. You can't just be like Florida for how many years was garbage. Nobody wanted to go play for the Florida Panthers, but all of a sudden they put together a good infrastructure, a good ownership group. They drafted and had some talented foundational pieces, and when you accumulate a roster like that, is it something that helps put you over the top? Perhaps that could be a contributing factor, but like you said, you also just need to get good on your own first. You can't just rely on the no state tax to help you to bring in talent, because that's not enough to construct a team. But all right, so we got that. So what kind of strategies can help mitigate this? I hear all the time about the RCAs, and I to a certain extent I believe the RCA argument's a bit of a flawed argument here, but I want to get your perspective on it, Kim. What strategies can help mitigate this impact?
Yeah, RCAs can sometimes be helpful. They're a little tricky to make them worthwhile when you're dealing with Canada, US. Like, for example, Steven Stamkos, if he set up his compensation and retirement compensation arrangement, and just for the benefit of your listeners who aren't familiar with RCA's retirement compensation arrangement are a trust. It's an arrangement that's a trust. And instead of negotiating a salary, what you do is negotiate a retirement portion of that compensation to be set aside for your retirement. And you do it vis-a-vis this trust arrangement. And the whole idea is that any dollar that's received by that trust, the first 50 cents of that receipt has to go into pay for tax. So you're only left with 50 cents, the other 50 cents in the trust. And then when you ultimately withdraw the dollar of assets, because the 50 cents that you pay in tax is refundable, but it's only refundable when you withdraw the monies. And so the idea is, if when you withdraw, can you have a withdrawal where it's not taxed as high? And it's very tricky to make that work with Canada, US. I'm not saying it's impossible, but it's tricky and a lot more rare.
But you basically have to be, a non-resident, like somewhere you have to be in a location where your residential tax rate is lower than that 50%, essentially.
Correct.
Okay.
Yes. Like, for example, there are some European jurisdictions where it can actually work really well, because what the first issue is that withdrawal going to be taxed in the recipient country?
Mm-hmm.
And there's some countries where it's not taxed, surprisingly. And if so, then you're only subject to a 25% withholding tax when it's ultimately paid out. Like, in other words, Canada will require a 25% withholding tax. So if you can get your final tax bill to be 25%, beautiful.
Right.
And that's where it's ultimately worked quite nicely, is you pick some jurisdictions. There are some practitioners who claim to have some strategies to make it non-taxable in the United States as well, but I'll leave it to those practitioners, because I find those a lot debatable.
Okay.
And because I think the withdrawal in the States is generally taxable. Yes, some people can debate me on that. But ultimately, if you can make the mathematics work, like let's say you withdraw when you're living in Florida, well, then maybe the delta might work.
Right.
Especially when you compare it to California, for example, which is one of the worst states ever. So that's kind of at least the game that's played. They used to be very, very common. I would say about 15 years ago. Not as common today, although still utilized in rare circumstances.
So basically, John Tavares, assuming he wants to retire in the Greater Toronto area because he has such an affinity for what's that bakery that he likes to go to? I'm gonna forget about it now. But anyway,
Serrano?
No, it's not Serrano's. Broadview, something like that. Anyway, it doesn't matter. I know he plans to retire in the GTA. So for somebody like him, considering he's going to be withdrawing from that, living in such a high tax jurisdiction, there's no real benefit.
As a matter of fact, there could be a detriment, right? Because on that refundable tax, the 50 cents in my example,
mm-hmm.
does the CRA pay any interest on that? The short answer is no, right? And so you got to factor that into, and this is more in your guys' area of expertise than mine, but you have to factor that into the analysis. And going to Austin Matthews, if he's going to retire in Arizona, well, the first issue is, how is the United States going to tax that withdrawal?
Right.
And how is Arizona going to tax that withdrawal?
Right.
And if it turns out they're going to tax it at a 40-some% rate combined, is the delta worthwhile? Yeah. Especially considering you don't get any investment income off the refundable tax.
Yeah.
It's a rare day that I see it make sense.
He'd have to go retire into Nevada or Florida or Tennessee or Texas or something of that nature to make it worthwhile.
Or a European country that doesn't tax.
All right. So William Nylander might be able to benefit from this.
Maybe, depending on the circumstances. Yeah.
Right. Okay. So I actually do want to touch upon the John Tavares situation. I want to get your perspective on it. But before we get to that, are there any other strategies that can benefit athletes? Is it whether it's deferred salary or getting it paid out as a bonus as opposed to salary, a signing bonus as opposed to salary? Are there none of those really matter anymore?
Well, I'll talk about the signing bonus stuff as when we talk about Tavares, but the short answer is no with respect to deferral, especially if you're a Canadian resident.
Mm-hmm.
There's significant broad-based rules that will tax any deferrals. Like let's say you sign a $10 million contract, but hey, pay me $1 million per year after I retire. Does that work? Short answer is no, it doesn't. Though there's what's referred to as salary deferral arrangement rules, SDAs as we call them. Very, very broad-based and generally won't work. Now, park that for a second and think about, I could never pronounce this fellow's name correctly, the Los Angeles Dodgers superstar, Shohei
Ohtani?
Yeah, that guy. He signed a monster deal with the vast majority of that being tax deferred. And so the short question is, would that work in Canada? And the answer is probably not because of these salary deferral arrangement rules. Does it work in the States? well, obviously it does, because otherwise, he'd be cash poor because he'd owe a bunch of tax. And he's already had the state of California that's come out and said, "Oh, we don't like this. We might change the law." I don't know if you've seen some of that.
I didn't see that. Oh, if I were Shohei, I'd be flashing them the fastball signal, except I'd be using the wrong finger.
Well, you should Google it. It's an entertaining story because there's been
Is that a Gavin Newsom
some.
brainchild?
Well, it's part of his.
He doesn't like the World Series that they just won him?
He's part of that. There's a bunch of lawmakers that are around him that basically have made the point that, hey, we don't like this. We think
It's California.
Oh,
That's
yeah.
all you have to say.
love the beauty of California, can't stand the politics, as
Yeah.
I'm sure you guys can't either. So
Yeah.
you can think about things like that if you're, if you're firstly a U.S. resident, and try to follow the Shohei Ohtani example. But in Canada, forget it. Generally.
All right, so let's talk a little bit about the Tavares case. Give us the broad strokes about what's going on there, Kim.
Yeah, that's I one of these days I'll have lots more to say. I can't say too much, for a variety of reasons, but what I will comment on is what's public, in the public domain. And in his case, he of course signed with the Leafs, received a big signing bonus, and he was in the first year he was a non-resident of Canada, which I think, based upon what I read in the public materials, pretty clear he was a non-resident of Canada. When you're a non-resident of Canada and you receive a signing bonus, that's paid from Canada, so in other words, it's Canadian sourced. The general rule is Canada has the right to tax that if it's Canadian sourced. And in this case, you'd be like Canadian source employment income, so fully taxed. However, there's a provision in the treaty that, in its Article 15 of the treaty, that says that if you receive a signing bonus, and I'm oversimplifying the language here, but if you receive a signing bonus, that and it's sourced to a particular country, so in this case Canada, the maximum amount that country is able to tax is 15%. And so here's the mathematics. Let's say it was $1 million signing bonus, and John is a resident of Canada, or try that again, resident of the U.S. at the time, and let's say he's a resident of Florida, or maybe it was New York. I don't know. I think if I recall, it's Florida, but I might be wrong. Was it Florida? Okay. But it's paid from the Leafs. Well, that $1 million signing bonus would normally be taxed at a high rate, but because of the treaty, it's taxed at 15%. So there'd be a 15% withholding. But is that where the tax stops? A lot of people, and I've written on this, a lot of people think that that's the final tax bill. Well, no, it's not, because the United States will still fully tax that signing bonus. It just so happens that it's at a lower rate than what it normally would be in Ontario. So if he's a resident of Florida, then there's no state income tax, and it'd be just federal tax. So let's call it 37%. So he'd pay $370,000. Oh, but $150,000 of that has already been paid, and so he'll get a credit against that 370, right? So, and then he'll write a check for the balance of whatever's owed. And so, is there a lot of mischief going on here? No, there's no mischief. What the mischief is from a country to country basis. Canada doesn't like the fact that they think they're screwed. Yes. And so the argument that's been made by Canada is that, hey, this is not a true signing bonus. This is disguised employment income. And frankly, between us girls, I think that's weak sauce. I think that's really, really weak. And frankly, if Canada wins this argument at trial, because it is scheduled to go to court, of course, that will have a huge ripple effect. Because to me, that's just wrong. It's completely wrong. And a signing bonus is a signing bonus. Would John Tavares have signed that contract if it was not done and structured in the way that it was done? I don't know the answer to that, but I would submit it. He would certainly have thought twice about it.
Yeah, exactly. And so this is where you get into the issue of, penny wise, pound foolish. You talked about in one of your articles came recently about when the federal government took over in 2016 and they raised the marginal tax rate for the highest income bracket. They said, oh well, it's going to raise so much revenue, not accounting for the fact that people then alter their behavior in order to pay less tax. Not to mention the fact that it also negatively impacted the provinces, because some of those people lowered their taxes and the provincial tax revenues went down, and so it ended up being a net negative for tax revenue.
I have to interject. When I said Florida earlier, that was just a feeble attempt at comedy. So I'm not sure where John Tavares was resident for that discussion.
Off the top of my head, I think it was Florida, but the obvious would be New York, but because he played for the Islanders. But
yeah, of course, yeah. So the question I have is, if there's a change of government at the federal level before the tax case comes to trial, is there a possibility the new government would not pursue it as fervently as the current government?
probably not, because governments generally stay out of the administration of justice. It would have to be so pervasive and so offensive for them to interject. So I doubt it. What they might do, though, is if they see a bad result from the from the courts, what they might be tempted to do is to try to change the law. But in this particular case, it's a treaty issue. It's an interpretation of the treaty, and so you'd have to get both Canada and the U.S. involved, which is a lot more tricky and a lot more time consuming. So I doubt it, but never say never. You don't know.
Kim, is taxation part of the reason why the NHL is reticent to return to Quebec City?
Oh, I think for sure that would be one of the elements. Absolutely. Besides the obvious of Quebec City being, a small market and harder to get to, those would be two of the other issues. And the third, of course, would be how attractive is Quebec City on the whole to professional athletes. But would tax be part of that equation? For sure it would be.
Is there anything that can be done to benefit the Canadian markets from a tax perspective, other than the obvious cut at the federal level?
Well, I think that's probably the only thing, right? That if you make it attractive for athletes, and it's just, and I've written on this a lot, right? It's not just athletes. Athletes are the easy to understand because they make a lot of money in general. But what about your tech executives? What about your, health executives? There's very, very talented people around the world that Canada needs. Ideally we would grow them, but we're a small country. And so when we go beyond our borders to try to, attract successful people to Canada to either lead organizations or start organizations or be entrepreneurs, tax is a big, big factor to that. And so the short answer is, yes, we need to make it attractive, which is one of the reasons why I like what Pierre Poilievre has announced, which I thought was very clever politically. In June of this year, he was under a lot of pressure to come out and say that he's going to reverse the capital gains inclusion rate. Well, there's no benefit for him to say that early, right? Because the election's not on the table. Right. But instead, what he did is he did a very astute thing. He knows that he's going to change things when he comes to government, if he becomes the prime minister. So why not state the obvious? I'm going to get people to look at the tax system and try to improve the tax system in a few core areas: productivity, putting more money in people's pockets, and making it better for entrepreneurs to as he said, make stuff. I like his plain English approach. So
works perfect.
And so in that case, that's a nice cover to say, hey, I'm going to look at all this stuff. He doesn't have to say he's going to reverse the capital gains inclusion rate because it would come under that cover.
That's a good place to put a pin into it, because that's an area we want to dig more into in part 2 here, Kim. So
sure, sounds good.
we'll from there we'll throw it back to Bill, and we'll let him take it away for our break.
Yeah, no, that's a great place to break it, because as a listener, I'm going to stick around for part 2 on that, especially if I live in Canada. This is a fascinating conversation, and it's fun. And I'm sorry you're all wrong, because New Jersey Devils,
Bill, the greatest contribution New Jersey has made is in the field of waste management, and I'm going to leave it right there.
I know. That's why I always pay my waste management bill on time. John.
Yeah. Make sure.
Not worried. All right, listen, everybody here listening to this podcast, stay tuned for part 2. But before we get out of here, let's wrap it up really, really quickly. Alex, John, for folks who are listening to the podcast who are thinking, I actually like these people, I might want to have a conversation with them, how do they reach out and get a hold of you?
Best way is just to go to our website. It's medwealth.ca. That's med-wealth.ca.
Beautiful. You can also do yourself a favor. If you're not a subscriber, hit the follow button, become a subscriber. Then when the next episode drops, you'll be notified and you can give it a listen. And yes, that does include part 2 of this particular podcast. So for now, we're going to wrap it up there. I'm Bill Tucker. On behalf of John, Alex, and everybody at MedWealth, thank you for taking the time to listen today. We'll see you over in part 2. And we will remind you that you can go out today and make today a great day or not. It's your choice. Have a good one. Until next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.